welcome to today's report, the 18th of September 2023. Okay, so let's move. Right. Today, I'd like to talk about the interest rate and the US consumers, because we really need to understand what is happening with the US economy, and because we have seen some leading economies, they have started announcing that they have ended their rate hiking cycle and so on like that. What about the US? When is the US going to stop? Because it carries a lot of trade developments. Very, very clear. If we know what's happening, then you can actually plan it out in detail right over here. So this is a table of the probabilities of rate hikes. Is there a rate hike or no rate hike? And as you can see, the September 20th meeting, FOMC meeting, there's a 98% chance that we are not going to see a hike or happening. Okay, so this is a high probability that we are seeing this. But you just can never discount. Even in 2%, there is a possibility, given that recent developments in the interest in in the what you call inflation in the US, as well as other data like the PPI. All these are showing this an increment. But nevertheless, looking at the probability table, the moment we surpass the 70% mark, right, the chances are quite high. And on top of that, you have several board members, as already stated, even those very hawkish ones, they have also said that if they were to increase, probably will be the next one, not this one. So with their statements, as plus these possibilities that we are seeing right now, there's a high probability we would not see a rate hike come 20th September. Now, we are also seeing that future rate hike possibilities dropping from 50% in November and December, previously I've shared that with you guys, to now below 40%. The rate hike possibilities has dropped below 40% November and December. Okay, so that has slowly changed, and these are the things that we need to think. They said, oh, they're dropping, they're not going to hike anymore, because in the past, I've also said the moment, when they stop hiking and then they change the whole thing into cutting the interest rates, the market will start rising. Is that the case? But you just can't just take it, accept it like that. You need to really understand the process that happens in between. So don't just because I've seen a lot of YouTubes they're celebrating and said, hey, the moment they stop this one, the market's going to rise and all these kind of things. And true, the market is rising. Last week, the beginning of the week, we saw the market rising, and we saw news portals saying that, yeah, the market is, well, everything is fine and dandy. But I have been saying that the market don't move like that. It will drop. There will be a correction in the market. So at the end of the day, hold your horses, don't celebrate too fast. That's what I'm saying. The market just don't, because they cut their rates and it will go up. Okay, the S&P 500 will just go up like that. Because last Wednesday, what we saw when the CPI was released, the Consumer Price Index released, it clearly shows that inflation remains sticky, right? And with that, because of that stickiness, the Federal Reserve would not want to repeat its mistake by cutting its rates prematurely. Okay, and because of that also, we should expect the rate hike possibility to remain. Even though it has dropped below 40%, there's always this possibility. But there's a but over here. Okay, it's leaning towards no rate hike for now, pending future developments. And there are very clear and precise reasons why it's leaning towards no rate hike for now. Okay, I did some research and here they are, because we looking into it, the US situation right here, if they were to increase its rates further, it would be detrimental to the US. In the past, the US, what happened was that they were supported, the past few months, they were supported by a very strong labor, okay? But that situation has changed, okay? Very, very clearly, that situation has changed because a very important statement was released by the Federal Reserve, and it goes like this. The Federal Reserve is predicting that the US consumer would be depleting their savings accumulated during the pandemic by October. We are in September. In another month, the US consumer savings would be depleted. And this is just not only by the Federal Reserve. News portals have been reporting them. Now, CNBC reported this. Look, 61% of Americans say they are living paycheck to paycheck even as inflation cools. Okay? And you have a report by Lending Club. It says lower income workers have been hardest hit by high prices, in particular food and other staples, since those expenses account for a bigger share of the budget. Roughly 3/4 of consumer earnings less than $50,000 annually, and 65% of those earning between $50,000 and $100,000 were living paycheck to paycheck. The report went on to say those earning $100,000 or more annually, that group, 45% reported living paycheck to paycheck in June and expected to worsen as the month progresses. Okay. Now, expenses of the US consumers is on the rise. You can't deny that. Here in Southeast Asia, you are seeing the same thing happening. Now, home prices are at record highs. They were portals that mention, that the housing is going to crash and stuff like that. But it's the other way around. Home prices are showing record highs. If you add in the high interest rates, that means home affordability is at record low. And as a result, people choose to rent. And when a lot of people rent increases. And the Bureau of Labor Statistics are reporting that rent has increased 18% on average right now in the US. And that is not good. Really, really not good. Okay. Now, we have also seen oil prices rising of late. At writing, US oil is at 91.17 US dollars per barrel. And this rise would certainly support goods and services price from dropping and may push it higher instead. Last thing, food prices rose 4.3% between August 2022 and August 2023, according to the most recent Consumer Price Index report. Now, you have shelter, you have oil, you have food prices going up. Then what's going to happen next? It's really going to add burden there. So I think that the most important thing is that, are there any more burdens that's going to be thrown into the US consumers? Now, I looked in further, and this I've also reported in the past already. That is the student loan payment. Now, to top that, this thing is going to hit all the people, the consumers, those that need to pay student loans in October. That's going to add stress to 43 million consumers. And they are reportedly going to pay an extra $300 to $400 US dollars a month. Now, they're already living paycheck to paycheck. You add this inside, it's really not going to be easy. So with the increase in the cost of living, are the consumers keeping up with their payments? That is also one part we need to check. Okay, those reported living paycheck to paycheck, but are they able to pay? Now, delinquency on credit card loans is on the rise and has surpassed pre-pandemic levels. Look at this here. This is the pandemic where the recession happened. And during that time, delinquency was here. Look at this level. This was the highest. And right now, it has already surpassed. So these consumers, they are plowing more and more on their credit cards, but they are not paying. And this is not a good development. Now, if you look at the delinquency rate on consumer loans, it's also on the rise. And it's very near to pre-pandemic levels. So you have credit card issues, you have also loan issues right now. So how? With such developments in the consumer sector, there's no need now. There's no such need to hike rates further, actually. And even there's one, it could be the last one in this cycle. Any more hikes will further burden consumers and add stress to the economy. So with this, when they are already living paycheck to paycheck, right, then they won't have that extra thing to like support these price increases, because at the end of the day, price increase is because there is low supply but high demand. But as demand drops, automatically prices will drop, right? That's economic 101. And because Fed is looking at this and said, hey, okay, the consumer, they're feeling the brunt already, and probably we might not increase further. There's no need. But like I said, you know, you can never discount. If there is, there's just one more and could be the last one. Okay, now what the Fed can do is to keep interest rates at elevated levels. That means for a longer period. But if they do that, something's bound to crack. Okay, and I wouldn't be surprised it would be the consumers looking at the consumer health at the current moment. Now, if unemployment starts to rise, wages growth starts to drop, yeah, that is going to speed up the whole process. So these are the data that I think is important going forward, looking at it. And the moment we see unemployment start rising, crossing the 4%, moving towards the 4.3% mark, yeah, that is when you're going to have issues. That correction is going to happen. So that's why I said that crack is happening. So look up for all these data going forward. And I think personally, even the Fed, they are coming to the end of the cycle like our other major economies. So this week, look out for the Bank of England announcement too. There's talks for hiking the rate to 5.25, right? So if the Bank of England also announced that would be the last rate hike, then yeah, things can change from here. Okay, so look out for that this week. And yeah, that's the end of the fundamental report for today.